to be speaking to you, sir. Thank you so much for taking the time out. Congratulations, strong set of numbers on a lot of parameters. Your Q4 profit has more than doubled. But of course, when we talk about the large part of it has actually come in when we, like I pointed out, from the deferred tax reversal linked to Cigniti merger. So if we, take that one-off out, how should the investors assess the real strength in the bottom line, sir?
I think you should assess the real strength basis the reported numbers. Our EBIT for the year has gone up 370 bits over the last year. More importantly, I would ask you to take performance going forward as the other key. The guidance for next year is more than 200 bits improvement in margin on an ongoing basis. And in the investor call, we'd also talk about the fact that that's the FY27 story, a 200 bits improvement in margin. FY28 will see a further expansion beyond what we see in FY27 itself. So that's the margin story. Of course, all of this comes off the back of a 9-year performance story, which at this point in time is unparalleled in our industry. For 9 years, we've grown at a CAGR of more than 21%. And for 9 years, our PAT has grown at more than 24%. This quarter, this year, is just an extension of the performance that we turned out over 9 years. And our forecast, our guidance for next year, as we rightly said, robust revenue growth, material expansion in margins, builds off that base and that proven performance.
Absolutely. So, sir, give me an understanding. When you give 20.5% plus kind of targets for FY27 for EBITDA, you're also expecting FY28 to further expand onto those levels as well, maybe 21 to 22%. Or if that's the target that you have, then despite the integration costs, despite the AI-led investments that you're doing and the global uncertainty, what exactly is giving you the confidence to make these margin commitments at this point in time? And what will help you drive that growth?
So the confidence comes from the fact that most of what needed to be done to get to these numbers is already done. And most of what needed to be done in this space was a program that we ran for the last 12 months, essentially the last 13 months in some ways, where we decided that whatever AI-based interventions, transformation, interjections that we were doing for our enterprise plans also needed to be embedded with intent and speed within our own internal operations. Going forward, we will keep our G&A costs flat. Sales and marketing will continue to expand. But the fact that a firm which is growing at the pace at which we are, we've been growing at about 29% in US dollar terms for the last 2 years. We see very robust growth ahead of us. If we keep absolute G&A flat, given the fact that we've already got about 25% G&A synergies post the acquisition of Encora as well, the 20.5 to 21% is an assured number. And that's why, as we offered this assured number, we said this program ain't going to stop. We will continue to drive automation and AI-based interventions across our G&A streams. And the following year, margins will expand further.
Right. So, sir, you've spent about $2.5 billion to acquire Encora, one of the biggest bets for Coforge as well. Give me an understanding, what is your expectation with Encora now completely on board? By when do we finally see the impact on the books also to be seen of the combined revenues and the margins as well? And of course, what is the peak revenue potential, if you could explain to us at this stage?
No, you will start seeing those numbers start getting reflected starting current quarter Q1 itself. Okay. We will consolidate for 2 months of the quarter, starting the 1st of May onwards, and you will see the impact on the P&L on an ongoing basis thereafter. From a slightly medium-term perspective, of course, the composite organization is now operating as more than a $2.5 billion unit. And our intent is to start hitting that $3 billion run rate on the revenue front at the earliest possible.
Right. Sir, we've been seeing that the industry has been grappling with weak discretionary spending globally, especially amidst this AI-led disruption that's being talked about, and of course a lot of geopolitical-led impact that we are seeing, maybe even the tariff-related issues. So Coforge still continues to report strong deal wins, healthy order book. So what are the sectors and the geographies that are driving this resilience for you?
I think it's a mix of sectors, geographies, and also the value pools. Discretionary spend is not uniformly weak. And I really want to call that out. There is a broad narrative out there which says that discretionary spend is weak, and the answer is no. Yes, of course, there are pockets where it is weak, but there are material pockets where discretionary spend is actually strong, getting stronger. Now, firms and teams that focus on labor as a default and discretionary spend tied to labor as a default are the ones who will continue to struggle on the growth front. But firms and teams that pivot towards addressing the demand that is coming in from AI-native process redesign, from operating as a delivery team with domain-enabled agents, from addressing the demand that is coming for agent lifecycle management, those teams will continue to do well. As far as outside these value pools, a growth that we expect, we talked about it and the investor conference as well. The reason why we can say with the confidence that we have that we will continue to drive robust growth is because FY26, all our verticals did well. Healthcare grew 98% in the year. Travel grew 71%. I think the worst performing vertical for Coforge in FY26 grew 12%. Going forward again, we find all our core verticals, whether that's travel, whether it's healthcare, whether it's insurance, banking, or the UK public sector, all trying for strong growth and hence the confidence and therefore the expression of that confidence in terms of the guidance.
And when we talk about FY27, sir, in the pecking order, what are the sectors or segments of yours that will drive the growth for you?
We think healthcare and travel will lead and will be followed very closely by the UK public sector, by banking.
Okay. So your executable order book now stands at $1.75 billion. It's already up 16%. So how much visibility does this give you for FY27 growth, especially amidst the fears of a global slowdown?
95% of our business is repeat business. The order executable number that we call out is the signed order book, which will be realized over the next 12 months. Given the execution intensity that has always underlaid our operations, we don't expect any slippage or any material slippage from what is already signed, booked, and locked. This 1.75 billion, also it's important to note, does not include other revenue streams that are merely assured because of framework contracts that we have signed in the public sector. So when we look at the 1.75 million and how sticky that revenue is, when we look at the framework revenue that will come in and is not counted in this, the aggregation of those revenues is what gives us a lot of confidence for the future.
So you've also invested about $5.5 million in AI in FY26. You've trained over 30,000 employees. Give me an understanding of what are the tangible outcomes that you're already seeing from these AI-led investments, and how do we see the investments pan out in FY27 specifically to AI?
I think the biggest outcome is the work that some of these AI-trained, AI-enabled, AI-first employees have driven in our internal operations itself. We aren't just going out there and selling outcome-based solutions. We are exemplifying outcomes that can be created through our own performance and through the margin improvement that we saw in FY26, that we have committed to in FY27, and that we will build upon in FY28. So that's the most tangible piece. The second thing, of course, is our ability to get out of the labor as a default value pool and focus on AI-native process redesign, domain-enabled agents, agent lifecycle management. All of that comes off the back of employees and team members who can actually operate in these spaces, have been trained in these spaces. And that's the other piece which ties into the revenue outlook that we shared, which continues to be robust.
So there's also this growing fear that AI can reduce the headcount growth in the IT services sector completely. We've been seeing so much of layoff news globally as well as domestically as well. So how are you really managing and balancing efficiency as well as continuing employment generation? So how will it affect your hiring trends going forward in FY27?
It is the best example of managing efficiency internally is the margin expansion that we looked at. We believe that this entire narrative, the meta-narrative that's getting built up around the fact that AI-generated code is going to be deflationary for the industry is only part of the story. It's not the full story. Of course, AI-generated code is cheap, much cheaper. But then that code needs to be maintained. And that's not cheap. That code needs to be secured. That's not cheap. That code needs to be integrated. So depending on which value pool you're looking at, depending on newer near-term, medium-term, long-term opportunities that are ahead, Near-term, modernization is a massive opportunity for firms that have the capability to address it. Medium-term, agentic AI rollouts, framework rollouts is a massive opportunity, but again, only for firms that can play there. And long-term, of course, with AI having come in, long-term, the technology spend expansion is going to be a big opportunity for firms that are left standing.
Okay, but what do you have to say when, these AI-led technologies are raising this fear of Indian IT sector's basic fundamental business models getting challenged? Do you think there is a large part of concern there?
Of course, there is concern. If the Indian IT sector business model is going to be based on labor as a default, then it will get challenged. But if the Indian IT sector model is based on being a true partner for AI-native process redesign, for being a true partner for firms that are looking for agentic lifecycle management, for being a true partner for firms, enterprises that are looking for partners who can monitor models, govern agents for them, then the sky is the limit. The Indian IT sector, I suspect, is going to see two kinds of growth. There will be firms that will engineer outcomes for clients. They will compound. And if there are firms that do not switch over from labor as a default as an operating model, those firms will increasingly find it in those teams a very difficult demand environment to operate in.
What do you anticipate as the biggest risk for you at this stage?
We feel very assured about our guidance. I mean, let me just start off with that very quick piece. The biggest risk to any firm at the current point in time is the ability not to be able to act and execute. There are a lot of people who are still in this entire paralysis or analysis phase, where everyone is thinking about what does AI do, what are the foundational models doing, what are the tool players doing. They are systems integrators. We are engineers. We are in the services space. As long as we train and are able to deliver along the new value pools that come in, there should be no issue. The biggest challenge, as always, will be making sure that we add people who can support this new agenda, that we retrain, and if required, exit folks who can't align with that even.
Absolutely. Do you also expect more mergers and acquisition opportunities from Coforge after Encora and Cigniti? And is the focus going to be largely on integration and execution? I ask this because of the free cash flow that you have on the books. And what's the plan with that, sir?
We don't have anything that's cooking right now. Our immediate plan is to make sure that we prove, just as we did with Cigniti and with SLK, that the acquisition that we've done at Encora builds massive shareholder value. We're feeling very assured about the fact that Cigniti was a great defining example, SLK, the way we handled it, was a great example. We just want to make sure that Encora is the defining example of how the right asset, integrated with intent, can create material shareholder value.
Absolutely. So there's also been a market chatter around Advent potentially selling a part of its stake in June. Are there any discussions or developments on that front?
None at all. And I can't speak on behalf of Advent. I can just tell you that the performance is likely to just be differentiated. Revenue is going to be extremely robust, and the margin profile will see a step jump up in FY27 and again in FY28.
What's the margin guidance that you can give us for FY28, sir? You're already talking about 20.5%. You're thinking of building on it. Would it be fair to expect a 21 to 22% kind of a band that is more comfortable for you now?
The margin guidance for FY27 is already 20.5 to 21%, and we will try to come, as you can imagine, close to 21%. It's still early days for FY28, so we're not giving a hard guidance around margins for FY28, other than the fact that we do believe that with everything that's happening around us and everything that we do for other enterprises, if we continue applying the same solutions and frameworks to our own business, our margins in FY28 will go up beyond this level.
All right, fantastic. Thank you so much, sir, for being with us. I wish you all the very best for the upcoming quarters and looking forward to more conversations with you as we progress into the new financial year. Thank you so much for being with us, sir.